Question 1. Which of the following best describes the concept of activities of daily living adults in the context of long-term care insurance? A. Activities that require high levels of cognitive function, such as problem-solving and decision-making. B. Basic personal care tasks that individuals need assistance with to maintain their independence. C. Complex medical procedures performed by healthcare professionals in a clinical setting. D. Financial management tasks that involve budgeting and resource allocation. Answer: B. Basic personal care tasks that individuals need assistance with to maintain their independence. Explanation: activities of daily living adults are the fundamental self-care tasks that are essential for maintaining personal independence and quality of life. They typically include bathing, dressing, eating, toileting, transferring, e.g., moving from a bed to a chair, and continence. In the context of long-term care insurance, a policy may specify that benefits are triggered when an individual is unable to perform a certain number of adults, indicating a need for long-term care services. Understanding a DLS is crucial as they help determine eligibility for benefits and influence the design of care plans. Question 2. Mr. Thompson is evaluating different long-term care insurance policies. He is particularly concerned about potential rate increases over time. Which feature should Mr. Thompson prioritize to protect against rising costs? A. Non-forfeiture options. B. Return of premium rider. C. Inflation protection. D. Short elimination period. Answer: C. Inflation protection. Explanation: inflation protection is a critical feature for long-term care insurance policies that helps ensure that benefits keep pace with the rising costs of care over time. This can be achieved through options such as simple inflation increases or compound inflation increases, where benefits increase annually by a certain percentage or in line with the Consumer Price Index (CPI). Mr. Thompson should prioritize inflation protection to safeguard his policy's value against inflationary pressures, as healthcare costs typically rise faster than general inflation. Non-forfeiture options and return of premium riders primarily address policy cancellation and premium refunds rather than ongoing cost adjustments. Question 3. Scenario question: MS Johnson, a 68-year-old retiree, is considering purchasing a long-term care insurance policy. She has a family history of Alzheimer's disease and is particularly concerned about cognitive impairment in the future. In selecting her policy, which benefit trigger should MS Johnson ensure is included to adequately address her concerns about potential cognitive decline? A. Activities of daily living adults. B. Skilled nursing facility coverage. C. Cognitive impairment benefit trigger. D. Short waiting period. Answer: C. Cognitive impairment benefit trigger. Explanation: for MS Johnson, who has a family history of Alzheimer's disease, including a cognitive impairment benefit trigger in her long-term care insurance policy is essential. Cognitive impairment triggers can activate benefits when the policyholder is diagnosed with conditions like dementia, even if they are still capable of performing most ADLS independently. This type of coverage ensures that MS Johnson would receive financial support if she develops cognitive issues which are not typically covered solely under adults. Therefore, understanding the types of triggers available in long-term care insurance policies is vital for making informed choices that align with her potential future needs. Question 4. Which of the following best describes the difference between renewable and non-renewable long-term care insurance policies? A. Renewable policies can be continued indefinitely at the policyholder's discretion, while non-renewable policies have a fixed term. B. Renewable policies have lower premiums than non-renewable policies, which are always more expensive. C. Non-renewable policies automatically convert to renewable policies after a specified time. D. Renewable policies can only be issued to individuals under 65 years of age, while non-renewable policies apply to all ages. Answer: A. Renewable policies can be continued indefinitely at the policyholder's discretion, while non-renewable policies have a fixed term. Explanation: renewable long-term care insurance policies allow policyholders to renew coverage at the end of each term without re-evaluation of their health status, provided premiums are paid. This flexibility is important for those who may develop health issues later. In contrast, non-renewable policies have a defined term after which coverage cannot be continued, making them less favorable for long-term planning. Understanding the differences between these policy types is crucial for consumers to choose the right insurance to meet their long-term needs. Question 5. What is a common reason for the denial of long-term care insurance claims? A. The policyholder failed to meet the age requirement. B. The policy was not paid for the previous month. C. The care provided was not pre-authorized by the insurance company. D. The policyholder did not report prior health conditions on their application. Answer: C. The care provided was not pre-authorized by the insurance company. Explanation: one of the most common reasons for the denial of long-term care insurance claims is the lack of pre-authorization for care services. Insurers typically require that certain types of care be pre-approved to ensure they are medically necessary and covered under the terms of the policy. Failure to obtain this pre-authorization can result in denied claims. Policyholders must familiarize themselves with their policy's requirements, including documentation and pre-approval processes, to avoid potential issues during the claims process. Question 6. Scenario question. Mr. Adams, a 75-year-old veteran, has recently been diagnosed with Parkinson's disease. He currently has a long-term care insurance policy that covers activities of daily living adults but does not mention cognitive impairment. Given his condition, what should Mr. Adams do to ensure he has adequate coverage for his care needs? A. Increase his premium payments to enhance benefits. B. Review and possibly update his policy to include cognitive impairment coverage. C. Apply for Medicaid as he no longer needs his current policy. D. Cancel his current policy as it will not benefit him. Answer: B. Review and possibly update his policy to include cognitive impairment coverage. Explanation: given Mr. Adams' diagnosis of Parkinson's disease, which can lead to cognitive impairment over time, it is essential for him to review his long-term care insurance policy to determine if it adequately covers his potential future needs. Since his current policy only addresses adults, he may not be eligible for benefits if he begins to experience cognitive decline, which is common in Parkinson's disease. Updating his policy to include cognitive impairment coverage would ensure that he has financial support for comprehensive care, including supervision or assistance related to cognitive challenges. Question 7. Which of the following statements about long-term care insurance inflation protection options is true? A. Simple inflation protection increases benefits by a fixed amount each year, regardless of inflation rates. B. Compound inflation protection allows benefits to grow exponentially, potentially keeping pace with rising care costs. C. Inflation protection is optional and does not affect the initial premium costs of the policy. D. Long-term care insurance policies with inflation protection cannot be sold in Arkansas. Answer: B. Compound inflation protection allows benefits to grow exponentially, potentially keeping pace with rising care costs. Explanation: compound inflation protection is designed to allow policy benefits to increase at a specified rate, typically compounded annually. This ensures that the value of benefits keeps pace with the rising costs of long-term care over time, which often outstrips general inflation. In contrast, simple inflation protection increases benefits by a fixed percentage but not compounded, which may not provide sufficient coverage in the long term. Consumers must understand these options when purchasing long-term care insurance to ensure their coverage remains adequate throughout their lives. Question 8. When considering the impact of family health history on long-term care insurance needs, which of the following factors should be most critically evaluated? A. The number of family members who have used long-term care services in the past. B. The specific types of chronic illnesses that family members have experienced. C. The overall longevity of family members without significant health issues. D. The financial status of family members who have used long-term care services. Answer: B. The specific types of chronic illnesses that family members have experienced. Explanation: evaluating the specific types of chronic illnesses that family members have experienced is crucial when assessing an individual's potential need for long-term care insurance. Certain chronic conditions, such as Alzheimer's disease, diabetes, or heart disease, may have genetic links and can increase the likelihood of requiring long-term care in the future. By understanding these factors, individuals can make more informed decisions regarding their insurance needs and the level of coverage required to address potential future health issues. Question 9. What is a key requirement for long-term care insurance policies under Arkansas law regarding marketing practices? A. All marketing materials must be approved by the Arkansas Department of Insurance prior to use. B. Insurers must provide a 30-day notice to policyholders before changing any policy terms. C. All advertisements must clearly state that long-term care insurance is a voluntary purchase. D. Agents must be licensed to sell both life and health insurance to market long-term care insurance. Answer: C. All advertisements must clearly state that long-term care insurance is a voluntary purchase. Explanation: Under Arkansas law, it is required that all advertisements and marketing materials for long-term care insurance clearly indicate that purchasing this type of insurance is voluntary. This provision ensures that potential policyholders are not misled about the necessity of purchasing such coverage and are fully informed of their options. It is important for consumers to understand that while long-term care insurance can provide significant benefits, it is not mandatory and they should carefully evaluate their own needs and financial situations before making a purchase. Question 10. In the context of long-term care insurance, which of the following is true about non-forfeiture options? A. They allow policyholders to continue coverage without paying premiums. B. They ensure that policyholders receive some benefits even if they stop paying premiums after a specified period. C. They are mandatory features in all long-term care insurance policies in Arkansas. D. They provide an option for beneficiaries to claim benefits after the policyholder's death. Answer. B. They ensure that policyholders receive some benefits even if they stop paying premiums after a specified period. Explanation. Non-forfeiture options in long-term care insurance policies are designed to protect the policyholder's investment if they stop paying premiums. These options provide a way for the policyholder to receive some level of benefits even if they cease premium payments after a certain duration. This feature is particularly beneficial for individuals who may face financial difficulties later in life but still want to retain some coverage. Understanding non-forfeiture options is vital for consumers to make informed decisions regarding their long-term care insurance policies and to protect their financial interests over the long term. Question 11. Which of the following best describes the term activities of daily living adults in the context of long-term care insurance? A. DLS are a set of standardized assessments used to determine eligibility for Medicare. B. DLS refer to a series of health metrics that evaluate the effectiveness of long-term care services. C. DLS are basic tasks essential for personal care that often determine the benefits payable under long-term care insurance policies. D. DLS encompass a wide range of recreational activities that enhance the quality of life for seniors. Answer. DLS are basic tasks essential for personal care that often determine the benefits payable under long-term care insurance policies. Explanation. Activities of daily living adults are fundamental tasks that individuals typically perform on a daily basis, such as bathing, dressing, eating, toileting, transferring e.g., moving from bed to chair, and maintaining continence. Long-term care insurance policies often use the inability to perform a specified number of these activities as a trigger for benefits. Understanding a DLS is crucial for policyholders as it directly influences their eligibility for coverage when they require assistance. Question 12. In the context of long-term care insurance, what is the significance of the elimination period? A. It defines the maximum duration of coverage for long-term care services. B. It is the time frame before benefits are payable after a claim has been filed. C. It specifies the length of time an insured must wait before they can change their policy terms. D. It indicates the period during which the insured can cancel their policy without penalty. Answer. B. It is the time frame before benefits are payable after a claim has been filed. Explanation. The elimination period, also known as the waiting period, is the duration of time that must elapse after the insured becomes eligible for benefits before payments begin. For example, if a policy has a 90-day elimination period, the policyholder would need to pay for their care out of pocket for the first 90 days before the insurance company starts to cover costs. Understanding the elimination period is essential for consumers to plan financially for the potential gap in coverage during this time frame. Question 13. Scenario question. Mrs. Thompson, a 68-year-old retiree, is considering purchasing long-term care insurance. She has a family history of Alzheimer's disease, but is currently in good health. What should Mrs. Thompson prioritize when evaluating her long-term care insurance options? A. The lowest premium available in the market. B. Policies that include coverage for cognitive impairment and Alzheimer's-related care. C. The reputation of the insurance company based solely on market share. D. Policies that require no medical underwriting or health assessment. Answer. B. Policies that include coverage for cognitive impairment and Alzheimer's-related care. Explanation. Given Mrs. Thompson's family history of Alzheimer's disease, it is crucial for her to prioritize long-term care insurance policies that specifically offer coverage for cognitive impairment and related conditions. Since Alzheimer's can significantly impact an individual's ability to perform, adults having coverage that addresses these needs will provide her with adequate financial protection in case she requires assistance in the future. What premiums and the insurance company's reputation are important. Ensuring comprehensive coverage is paramount for her situation. Question 14. Which of the following statements about long-term care insurance and Medicaid is true? A. Medicaid always pays for long-term care before any long-term care insurance benefits. B. Long-term care insurance benefits are available regardless of the individual's income level. C. Individuals must exhaust their long-term care insurance benefits before they can qualify for Medicaid. D. Medicaid does not cover any long-term care services. Answer: C. Individuals must exhaust their long-term care insurance benefits before they can qualify for Medicaid. Explanation: in many states, including Arkansas, individuals must typically exhaust their long-term care insurance benefits before they become eligible for Medicaid coverage. This means that any available insurance benefits must be utilized first. Medicaid acts as a safety net for those who have depleted their personal assets and insurance coverage. Understanding this relationship is critical for policyholders to effectively plan their long-term care strategy and financial future. Question 15. What role does the Arkansas Department of Insurance play in the regulation of long-term care insurance? A. It creates the long-term care insurance policies that insurers must use. B. It approves all long-term care insurance claims submitted by policyholders. C. It monitors insurance companies for compliance with state regulations and consumer protection laws. D. It offers long-term care insurance policies directly to consumers at a lower cost. Answer: C. It monitors insurance companies for compliance with state regulations and consumer protection laws. Explanation: the Arkansas Department of Insurance is responsible for overseeing the insurance market within the state, including long-term care insurance. This agency ensures that insurance companies comply with relevant regulations and laws designed to protect consumers, such as marketing practices, policy provisions, and claims handling processes. Their role is not to create policies or approve individual claims, but rather to maintain a fair and transparent insurance marketplace. Question 16. Which of the following is a potential benefit of adding an inflation protection rider to a long-term care insurance policy? A. It guarantees a fixed premium payment for life. B. It ensures that benefits will increase over time, keeping pace with rising care costs. C. It provides immediate cash benefits for all long-term care services received. D. It allows the policyholder to skip the elimination period for claims. Answer: B. It ensures that benefits will increase over time, keeping pace with rising care costs. Explanation: adding an inflation protection rider to long-term care insurance policy allows the benefit amounts to increase over time, either through simple or compound inflation adjustments. This is critical because the cost of long-term care services typically rises faster than general inflation, and having inflation protection helps ensure that the policyholder's benefits remain adequate to cover these rising costs. This feature is important for maintaining the policy's value over the long term. Question 17. What is the purpose of a return of premium option in a long-term care insurance policy? It guarantees that the policyholder will receive a certain percentage of their premiums back if they do not use the policy. B. It provides a one-time payment to beneficiaries upon the policyholder's death. C. It allows policyholders to recover all premiums paid if they cancel their policy. D. It ensures that premiums are adjusted annually based on the policyholder's age. Answer: A. It guarantees that the policyholder will receive a certain percentage of their premiums back if they do not use the policy. Explanation: the return of premium option is a feature that allows policyholders to receive a refund of a specified percentage of their paid premiums if they do not make a claim on their long-term care insurance policy. This option provides a level of financial reassurance for individuals who may be concerned about wasting money on premiums if they do not require long-term care. However, this option typically comes at an increased premium cost, and consumers should weigh the benefits against the additional expense. Question 18. In evaluating long-term care insurance policies, what is the significance of policy limits? A. They dictate the maximum number of years benefits can be claimed. B. They refer to the maximum dollar amount the insurer will pay for covered services. C. They indicate the minimum coverage required by state law. D. They define the number of a DLS that must be unmet to trigger benefits. Answer: B. They refer to the maximum dollar amount the insurer will pay for covered services. Explanation: Policy limits are the maximum amounts that an insurance company will pay for covered long-term care services within a given time frame, such as per day, per month, or over the life of the policy. These limits are crucial for consumers to understand because they directly impact the financial coverage available when long-term care is needed. Choosing the appropriate limits is essential to ensure that individuals are adequately protected against the high costs of long-term care services. Question 19. Which of the following is not a typical feature of long-term care insurance policies? A. Daily benefit amount. B. Guaranteed renewability. C. Mandatory coverage for Medicare services. D. Policy exclusions. Answer. C. Mandatory coverage for Medicare services. Explanation. Long-term care insurance policies do not typically include mandatory coverage for Medicare services. Instead, they are designed to cover services that Medicare does not fully address, such as custodial care or extended care in a nursing facility. Typical features of long-term care insurance include a daily benefit amount, guaranteed renewability, and various policy exclusions. Understanding these features helps consumers make informed choices about their long-term care coverage. Question 20. What is the primary difference between individual and group long-term care insurance policies? A. Individual policies are generally less expensive than group policies. B. Group policies often provide more comprehensive coverage than individual policies. C. Individual policies are purchased by individuals, while group policies are offered through employers or associations. D. Group policies require medical underwriting, whereas individual policies do not. Answer. C. Individual policies are purchased by individuals, while group policies are offered through employers or associations. Explanation. The primary difference between individual and group long-term care insurance policies lies in how they are acquired. Individual policies are purchased directly by consumers based on their specific needs and health status. In contrast, group policies are typically offered through employers, associations, or organizations and may have different underwriting requirements and premium structures. Group policies often benefit from lower premiums due to the larger risk pool created by many participants, which can lead to cost savings for the insured. However, group policies might have less flexibility in terms of customization and may impose certain eligibility requirements set by the employer or association. Understanding these distinctions helps consumers choose the right type of long-term care insurance that meets their specific needs and circumstances. Question 21. Which of the following statements accurately describes activities of daily living adults as they relate to long-term care insurance? A. DLS are solely defined by the ability to perform basic self-care tasks without assistance. B. Long-term care insurance policies generally do not cover assistance with adults. C. A DLS are used to determine eligibility for benefits under a long-term care insurance policy. D. The inability to perform a DLS is not a requirement for triggering benefits under long-term care insurance. Answer. C. DLS are used to determine eligibility for benefits under long-term care insurance policy. Explanation. Activities of daily living adults are essential personal care tasks that are used to assess an individual's need for long-term care services. The 6 standard DLS include bathing, dressing, eating, toileting, transferring, moving from one position to another, and continence. Most long-term care insurance policies require the inability to perform a specified number of these DLS to qualify for benefits. This criterion helps insurers determine the level of care required and when to activate benefits. Question 22. When considering inflation protection in long-term care insurance policies, what is the key distinction between simple and compound inflation protection? A. Simple inflation protection adjusts benefits based on the consumer price index, while compound inflation protection does not. B. Compound inflation protection increases the benefit amount each year based on a percentage of the current benefit, whereas simple inflation protection increases benefits by a fixed dollar amount. C. Simple inflation protection increases benefits at a flat rate, while compound inflation protection accumulates growth over time, resulting in higher eventual benefits. D. Both types of inflation protection provide the same level of benefit increase but at different premium costs. Answer. C. Simple inflation protection increases benefits at a flat rate, while compound inflation protection accumulates growth over time, resulting in higher eventual benefits. Explanation. Inflation protection is crucial in long-term care insurance to ensure that benefits maintain their purchasing power over time. Simple inflation protection typically offers a fixed increase in benefits, such as a flat percentage annually. In contrast, compound inflation protection calculates increases based on the accumulated value, meaning benefits grow exponentially over time. This difference is significant as it affects the total benefits available when they are needed in the future, especially considering the rising costs of long-term care services. Question 23. Mr. Thompson is considering a long-term care insurance policy but is concerned about the potential for premium increases. Which of the following policy features should Mr. Thompson inquire about to address his concerns? A. Guaranteed renewable feature. B. Exclusions and limitations. C. Non-forfeiture options. D. Elimination period. Answer: A guaranteed renewable feature. Explanation: a guaranteed renewable feature in a long-term care insurance policy ensures that the policyholder has the right to renew the policy each year without the insurer being able to cancel it or deny renewal based on the policyholder's health status. However, this feature does not prevent the insurer from increasing premiums. Mr. Thompson should specifically look for policies that offer rate stability or have safeguards against excessive premium increases, as well as inquire about the history of premium changes for the insurer's policies. Understanding the implications of the guaranteed renewable feature is crucial in evaluating long-term affordability. Question 24. Under the Arkansas Insurance Code, what is a primary consumer protection provision regarding long-term care insurance marketing practices? A. Agents can provide misleading information as long as they believe it will benefit the client. B. Insurers must disclose all policy terms and conditions without exception. C. Policies must be marketed without emphasizing the importance of obtaining coverage. D. Consumers must be provided with a clear summary of benefits and coverage limitations before purchasing. Answer: D. Consumers must be provided with a clear summary of benefits and coverage limitations before purchasing. Explanation: consumer protection provisions in the Arkansas Insurance Code require insurers to clearly disclose the benefits, coverage limitations, and exclusions of long-term care insurance policies. This is essential for informed decision-making by consumers, allowing them to understand what they are purchasing and how it aligns with their needs. Agents and insurers must adhere to strict marketing regulations that prohibit misleading or deceptive practices to protect consumers from potential financial loss and ensure that they receive appropriate coverage. Question 25. Which of the following would not be considered a qualified expense under a long-term care insurance policy? A. Home healthcare services. B. Assisted living facility costs. C. Cosmetic surgery. D. Adult daycare. Answer: C. Cosmetic surgery. Explanation: qualified expenses under long-term care insurance generally include services that address the care needs of individuals who are unable to perform activities of daily living, adults, or have cognitive impairments. This includes home health care, assisted living, and adult day care services. Cosmetic surgery, however, is elective and not related to long-term care needs, making it a non-covered expense under most policies. Question 26. Mr. Jennings has a long-term care insurance policy with a 90-day elimination period. He requires care immediately after being diagnosed with a severe cognitive impairment. What does the elimination period mean for Mr. Jennings' claim? A. His benefits will start immediately upon the diagnosis. B. His benefits will begin 90 days after his need for care starts. C. His benefits will only cover care provided after the elimination period ends. D. He will receive partial benefits during the elimination period. Answer: B. His benefits will begin 90 days after his need for care starts. Explanation: an elimination period in a long-term care insurance policy functions as a waiting period during which the insured must cover the cost of care out of pocket before benefits begin. Mr. Jennings' policy specifies a 90-day elimination period, meaning his insurance will start paying for care 90 days after his need for care was established. Question 27. Which of the following is a benefit of including an inflation protection rider in a long-term care insurance policy? A. It increases the policy's premium over time. B. It ensures the policy's benefit keeps pace with the rising costs of care. C. It decreases the elimination period of the policy. D. It automatically increases the lifetime maximum benefits. Answer: B. It ensures the policy's benefit keeps pace with the rising costs of care. Explanation: an inflation protection rider is designed to increase the benefit amount over time, helping the policyholder keep up with the rising costs of long-term care services due to inflation. Without this rider, a policy that seemed adequate when purchased may not cover future care expenses, as healthcare costs tend to rise over time. Question 20. Which of the following situations would most likely result in a denial of a long-term care insurance claim? A. The insurer cannot perform two activities of daily living adults and has paid premiums on time. B. The insured is still within the policy's elimination period. C. The insured has been diagnosed with a cognitive impairment, such as dementia. D. The insured needs adult daycare and the policy explicitly covers it. Correct answer. B. The insured is still within the policy's elimination period. Explanation: a long-term care insurance claim may be denied if the insured is still within the elimination period, as this waiting period requires the insured to pay for care out of pocket for a certain duration before the policy benefits become payable. After the elimination period ends, the claim can proceed if all other conditions are met. Question 29. When considering the purchase of a long-term care insurance policy, why is it important to review the insurer's financial stability? A. It determines the types of long-term care services covered. B. It ensures that claims will be paid even if the insurer faces financial difficulties in the future. C. It affects the length of the elimination period. D. It impacts the cost of premiums directly. Answer: B. It ensures that claims will be paid even if the insurer faces financial difficulties in the future. Explanation: the financial stability of an insurer is critical because a policyholder might not need to use the policy benefits for many years after purchase. An insurer with poor financial health may struggle to pay claims or go out of business. Choosing a financially stable company ensures that the policy will remain valid and benefits will be paid when needed. Question 30. Which of the following is not a factor that determines the cost of a long-term care insurance policy? A. The age of the applicant at the time of purchase. B. The applicant's gender. C. The length of the policy's elimination period. D. The applicant's income. Answer: D. The applicant's income. Explanation: the cost of a long-term care insurance policy is influenced by factors such as the applicant's age, gender, health status, the length of the elimination period, and the level of benefits chosen. However, the applicant's income is generally not considered in the pricing of the policy, although it may influence their ability to afford certain coverage options.